Futures ahead of the PPI inflation data this morning are still okay. The S&P and NASDAQ both all-time closing highs yesterday. Join us now. I called you Caffrey earlier. He's the other guy. He's the news guy for years and years in the New York area. You are not him.
I am not Jack Caffrey.
All right. You are Jack Caffrey.
Jack Caffrey.
Equity portfolio, to like an abbreviated Caffrey. Equity portfolio manager, JPMorgan Asset Management. I guess just to try to distill down what you're saying, the market's not cheap. There's some positive things that you see happen, but we definitely have gotten back to a point where it's not cheap. And would you call it an AI premium?
Certainly, if we try digging into valuations, the market trades at 23 times earnings.
Is that if you back out the big stocks?
Let me back them out for you.
Is it 17
so
then?
If you look at a cap-weighted multiple, it's closer to 29 times earnings.
Oh boy.
23 across the index, and median stock is trading about 19 times earnings.
19.
So you have a magnificent cohort, and call that's been driving anything touching AI, and that's been driving 70% of the gains this year. That's not just chips, that's not just the software, but it can be the industrials that wind up building the shell, that build the air conditioning to keep those very expensive chips happy and operating in their environment. Step away from the AI trade, and the market's been a lot more becalmed. You can think of it sort of as the forgotten 493 for the non-magnificent seven names. And that's one where hopefully lower interest rates, hopefully policy clarity can let companies be a little bit more confident with their spending decisions, and you can see a broadening out of the broadening in the market.
Even in the Russell, which was what you probably say we've been seeing in recent sessions. Still not at an all-time high, but there's some broadening out. So we were talking yesterday about how we've gone from where we were really worried about everything in April and how it was going to work out, and then for a while we were hoping everything was going to work out. You say at this point the notion is things really are going to work out, and even better than people thought. And that makes you nervous, probably.
If you look within numbers, earlier this year we were thinking 5% growth for the year. As a result of going through earnings season, it's closer to 7% growth.
For earnings.
That's really been just a surprise we've experienced, and our forecasts are for closer to 13% growth next year. So certainly there is some broadening to go there. I do think, if we step back to what we were experiencing in April, I actually thought it was going back to psychology, and you're thinking about Kubler-Ross's stages of grieving. Denial, grief, anger, all that, April 2nd to April 10th, and now we're working through bargaining and acceptance. Acceptance of what policy might look like, and bargaining in terms of what your tariff is going to be or what your export license will cost you. But effectively, we're working our way through, tell me the rules, and then I'll tell you how people play.
One of the Fed people said, it'd be nice to have a cut, but with labor where it is, or the unemployment picture, 4.2%, there's no rush, but inflation doesn't look like, at this point, it looks like we were worried too much about inflation. Do you expect it to start ticking back up and go above 3, where the Fed really does have a problem?
I think there's some inconsistencies in the economic narrative. Certainly, to the extent you've had people very recently pounding the table for not an intra-meeting cut, but a 50 basis point cut here and now, particularly in the back of the weaker job revisions 2 weeks ago. The Fed cutting 50 is a Fed that's panicking, that they've lost control and something horrible is occurring, like COVID. Right. Like you can't roll commercial paper and you've got $120 billion of it. That prompts a 50 basis point cut. The Fed is telling you they want to be friendly. The dot plot is pointing to, we're getting the information we want. We're not getting what we want to see on the inflation front as quickly as we want to see it. Certainly, when you look within, there are some trends that point higher. Gasoline prices down, electricity prices higher. So certainly there is some, where the economy wants to go, more electricity for everything. That's not getting as cheap as people would have hoped. Exporting natural gas probably actually snugs that up over time. And yet, that leaves the Fed in a bit of a quandary. Unemployment's not that bad.
In the past, we had, I think it was L. Arian or something, said that, 3.5 is okay. And if you do the math in 10 years on 1.5 on inflation, it's very debilitating, that extra 1.5.
Yeah.
But Summerlin, who we're going to have on, says yeah, these numbers, we don't really know exactly where. 1 to 3, anything 1 to 3 on inflation is within the Fed's. So now that people are arguing that maybe it can't be such an exact science, and that 3 is okay.
Well,
do you think 3 is okay? You like 2? Is the Fed going to move the goalposts?
I think the Fed moving the goalposts will cost the Fed credibility.
You do. So you like 2. I like 2.
I like, I recognize that the only thing I have massive confidence in is economic data gets revised.
Yeah.
So anyone who completely hangs themselves on any one data point is setting themselves up for disappointment. I will push back to the idea we want to look at the overall trend in surprises, better or worse. Better surprises gives you more confidence in earnings. Ultimately, you are talking to an equity portfolio manager, so I generally think equities are a better place to be.
You're just managing portfolios. You're not setting year-end targets for the S&P, are you? You're not stupid enough to do that.
I'll give you time or level, never both. But I'll go back to the idea of, the trend in earnings has been higher.
We'll hit 7,000 this century. That's all you'll say on the S&P?
I feel like I'm getting caught into a Kevin
Hassett.
Next
century.
A Kevin Hassett 1999.
By 2100, will we hit 7,000 on the S&P? If you say you won't give me duration or price target.
Direction is higher.
Okay.
Be along good companies.
That's good enough.
And manage your risks accordingly.
Okay.